Hirander, thanks for joining me on this conversation. You are the CEO and founder of GMEX and our group of companies that work in the conjunction of what we call Defi and tradfi. And we've recently witnessed the collapse of a certain number of companies, such as Celsius, Vauld, Babel, etc., which form part of what we call Cefi. What's your overview of what happened?
Yeah, a pleasure to be here, George. A very interesting question. I mean, Cefi, to me, can be broken down into a couple of different areas. I mean, one is more the buying and selling and activity on the likes of Coinbase and others that have been around since shortly after the advent of Bitcoin in 2009. But then those models have evolved in various ways into some of those names that you mentioned, like Celsius, etc., that were more around borrowing and lending and pledging of these crypto assets. And of course, moving away from a traditional buy and sell model, when you move into borrowing and lending of assets, it raises the question around whose assets are they? What mandate do you have to lend them? Obviously, there's a return and there's a profit involved in that. But obviously, as we've seen, recent events have outlined that these models went without their risk. And many have come a cropper. By to me, split into those types of activities, but the general point being they're centralized activities, no matter what some of these proponents or organizations would lead you to believe about them being hybrid or them being decentralized.
You mentioned Bitcoin, and I think that's a good place to start because they were indeed making operations on the blockchains and then delivering it to some people in an app that perhaps looks a bit like what we're already familiar with. So it's one of those experiments that we can attach to the blockchain, and it all started with Bitcoin. And I'd like to look back and try to retrace a bit the big steps of crypto. So if we start by, let's say, the 3rd of January 2009, where we have the first origin block, I mean, can you remind us a bit, how was crypto back then and in the early years?
Yeah, I mean, very nascent. Very few people knew about it. And those that did, it was almost like a peer-to-peer type of transfer and exchange, but it required a lot of tech savviness as well. And then the early exchanges emerged. I mean, the most well-known of the early ones was Mt. Gox, which is famous for that big hack, which meant it ceased operations in February 2014. It got, before that, quite a reasonable amount of volume and a lot of interest, which, with Asia being the early front runner, given banking and other aspects were less pronounced and mature in some of those markets, or there's macroeconomic factors at play post 2008. Certain markets like Korea, Japan, Vietnam, they got early adopters into this type of technology. But that said, the US wasn't far behind because Coinbase emerged in June 2012 as well, just over 3 years after the advent of Bitcoin. And obviously that's listed now and is one of the major cryptocurrency exchanges. But then as we progressed, a plethora of Cefi exchanges emerged, and then the processes started to evolve because a lot of the hacks and other things were down to not necessarily the technology per se, but poor operational processes as well. And some of that is lackadaisical controls or lack of controls thereof as well. Mt. Gox was one prime example of that. When we moved into offering a crypto asset offering on the exchange side, we looked into the failures and what was successful. And we found actually more than the technology, it was those operational procedures, surveillance, risk management. But I think really with this, what's really emerged is then how that exchange model has deviated away from its original kind of basic form into some of these other areas, which has also led to some opportunity, but also issues as well.
Yes, indeed. And what I've always found very interesting as an investor as well is the opportunities that come from non-directional returns, yield coming from what we call DeFi, decentralized finance. And again, if we look at it historically, I think, well, it started with Ethereum, which I think went live in 2015. And then based on that, there was a whole network or ecosystem of applications, and many of them allowed to create, so of course there was a lot of trading, people could buy and sell, and I guess that's the main activity. But what links to Cefi is that there were many ways unknown before to generate yields. And you mentioned some of them, staking, lending, etc., available at every level. Can you tell us a few words about this DeFi, for lack of a better word?
Yeah, I mean, one thing there, decentralized finance is a point. Is it really decentralized? I mean, it's interesting. There's a big debate around this, even in the US now, where the Securities and Exchange Commission had a definition of exchanges or automated trading systems, and in terms of buying, selling, matching orders to generate trades. But that definition is under review now, because you may have a smart contract, I may have a smart contract, or we may execute a transaction over that smart contract, but actually there may be no central body involved for us to do that, and there doesn't need to be. But that said, typically the discussion has been around who does really control it, because even if you're a decentralized autonomous organization, or a DAO as we call it, there's someone behind that, whether it's developers with the code, whether it's someone that has more control over the consensus mechanism. And so it's not necessarily clear cut, because even some of those offerings that are touting themselves as decentralized in reality could be partially centralized or more centralized than they make out. So in that sense, under that SEC example, these sorts of decentralized forms of exchange are now being considered as part of that broader exchange definition, and whether that's included and amended to reflect.
Yes, it did. There was this famous example called Sol-N, which is a autonomous, let me find the exact wording, autonomous interest rate machine. So it sounds very decentralized. And I'm not going to go for the details, but because of an issue, they decided to do a vote, which they obviously control it. They did it on a Sunday afternoon to make some drastic changes and controversial changes to the way they operate. We're going a bit off piece, but I think that's an important question. I think there's interesting attempts. I think MakerDAO, for example, is a pretty advanced example. But if they're not decentralized, how should we call them? Should we call them financial application on the blockchain? Would that be a better word?
Yeah, I mean, essentially it boils down to what's the definition, and it really does relate back to what you're saying, because there's three buckets that I would put things into, and then there's a fourth bucket as a result. I mean, the first bucket is traditional finance, or TradFi. We all know what that is. It's self-explanatory to a broad degree. Then there's Cefi, or centralized finance, and we've spoken about that with the exchange models and some of those borrowing and lending models that with staking that generate yield. And then there's decentralized finance as well. But equally, mix of those three, and Cefi typically is referred to crypto type of activity that's more centralized as opposed to traditional finance. But a combination of a hybrid of those becomes hybrid finance in the words that we've recently described them as a firm. And that could be three of those buckets reflected, or even two of those buckets reflected into hybrid finance. But that said, something like Celsius used to tout themselves as a bridge between TradFi and Defi, but you really got to question whether that was the case and what that really means as well. It means different things to different people.
So indeed, it's more like we talk about hybrid finance because, so they're not silos or buckets, because they all operate in between the two, except TradFi, which is clearly on the TradFi side, but maybe there's also more things that may operate on the blockchain, right, on this side. And indeed, Cefi, when you say or Celsius, to take that example, for me, what they were doing is they were doing, like, in the back end, some DeFi or operations on the blockchain. And the front end was something that was very much something that we're familiar with, like an app. And I feel like that's what at least this group of Cefi were doing. Basically, you could have access much easier. Anyone could have access to it, but we're operating on the blockchain. And that means as well the Cefi word, it doesn't really mean anything.
Yeah, I mean, because the challenge there is, you're right, you're aggregating all of that into a single app with a common user experience. But a lot of the plumbing at the back is where there's real activity, because everyone speaks about blockchain as one ubiquitous technology, but actually there are multiple blockchains. So when we speak about silos and buckets, and effectively a lot of these or all of these blockchains have their own form of technology and how they work, irrespective of whether proof of work or proof of stake. So a lot of these centralized finance activities, of course, you need to settle some of those, whether it's on-chain or off-chain. But ultimately, if there's a Bitcoin transaction, even if you net off activity, you need to access the public Bitcoin blockchain. And then Ethereum is the same. And so ultimately what's then involved is that kind of that back-end plumbing where you have to connect to multiple blockchains from that app on the front end side. And that's where some of the complications lie, because in periods of high volume or periods of high market stress, those deposits and withdrawals become a challenge. And obviously we all know that there's limitations with some of these blockchains in terms of block rights and so forth. The infrastructure doesn't necessarily keep up with the activity in periods of high volume, for example.
Right,
that's where the challenge lies, trying to address that kind of scalability issue inherently.
Indeed. And we know as well from Celsius that things worked fairly well until they had billions in assets, which came really quickly and suddenly. And that's when they started to struggle to deploy, which I guess is also a typical asset management problem. But here it's aggravated by this, what you just mentioned, right? The fact that the infrastructure is limited. And as it's growing fast, the infrastructure has to adapt.
Yeah, because as we've seen, the markets evolved, and then again in the autumn of 2018, the first crypto winter, and then Bitcoin fell to a low kind of January 19, where it was around 3,000 US dollars. But you had a lot of innovation and more adaptation, but then a lot of words are used like this is institutional grade and et cetera. But in reality, one's got to remember traditional infrastructure has been around for many decades, and then it's evolved. Yes, it's more centralized. There are things like Swift network as well. Obviously, a lot more silos with a multitude of exchanges as well, in respect to certain things emerging like open banking standards. But in the crypto space, there's a lack of common standards. There's a lack of common regulation. So there's different pockets of activity where certain entities are doing certain things in their own unique fashion. Some of that is now changing, and certainly market events like we've seen recently help accelerate that. And ultimately, that's a good thing as long as it doesn't stifle innovation.
Sure. Okay, you're giving us there's quite a nuanced, at least definition in terms of what we're calling what. And I guess what we have at the moment is not very appropriate if we want to be precise, and it's bound to evolve. And we're going to get to that later. But going back again to this 3rd of January 2009, I want to explore a different aspect of this period beyond crypto. So the Genesis blog had this famous message, Times, 3rd of January 2009, Chancellor on brink of second bailout. This is an actual title from the Times that was encrypted there. Do you see this message as a coincidence, or was it very carefully chosen?
Yeah, I mean, I'd say the latter, carefully orchestrated. But that said, there's no coincidence that Bitcoin came about in 2009 after the banking crisis of 2008, and effectively macroeconomic mismanagement that was rife. And the irony is some of the risks that we're seeing play out with certain events in the crypto sector. I mean, they played out in the TradFi sector in 2008 with ripple effects, with mortgage-backed securities, and then everything that ensued with the likes of Lehman Brothers going down. So it's not as if it hasn't happened on the traditional finance side, but that happening brought an evolution in terms of that market structure and the way that risks were handled going forward. And things like regulations and policy considerations around Basel III, which will translate and become Basel IV next year, capital adequacy and tier one capital reserves, what proportion of those banks can lend out as assets. And a lot of that was brought in place and put in place because of what happened. And then the irony is, I mean, this has happened again in the crypto sector because those standards haven't been followed in the crypto sector, and they're there for a reason. And of course, that's exacerbated by the fact that this asset class, or these asset classes, crypto as an asset class, to describe it as a whole, is still evolving as well. There's more volatility. And therefore, with a lot of these lending platforms, what seemed to be a good haircut where you provide them an asset and they may lend, let's say 60% against that and think, okay, great, the asset's not going to drop below 60% of its value. And therefore I'm covered in terms of my risk. And all of a sudden, if the price halves, you're underwater. And not only that played out, but the fact that there was lending going on with assets that didn't really exist, or lending was going on with assets that were held by certain entities. And those that held the assets there didn't even know that they were being lended out. It's a process in traditional markets called rehypothecation, but there needs to be client agreement around that, and agreement around which assets are segregated vis-a-vis which ones are. And not all of this was quite opaque in a lot of these platforms, and everyone got very obsessed with yield and the interest rate they were getting rather than the risk that they were facing, really.
And just to characterize what's happened, well, since January 2009, we had turned into a, I think, never seen before, low yield and quantitative easing environment. Is that how you would put it?
Yeah, and also effectively, since that time leading up to recent increases given inflationary pressures, interest rates have been very low, and effectively with inflation rising, effectively in real terms, incomes and net income has been going down in terms of purchasing power. And therefore, it's natural in those periods, people look for assets that generate a higher return. And crypto has been one such asset class, which has generated some phenomenal returns up until that recent market correction. And it's natural that you'll always have those that get into the asset class and then lots of followers, and then the hype cycle ensues and everyone kind of piles in. And then there's a market correction. And typically, at the wrong end of it ends up being retail investors as well. But certainly the macroeconomic climate has played a part, because there's been very few asset classes that have been able to generate any returns or returns that are tangible at all, really. And therein lies some of the issue.
Yes, indeed. I remember we were talking not so long ago about TINA, right? There is no other choice than equities. That was the thing, because fixed income was clearly not yielding anything. People were piling on equities, but I guess people were also attracting in other things. And yield is something that is attractive per se for many people. So that gives us, I think, the macroeconomic environment, which we know of, but that means it's interesting to position those yields, which were really at the front of those CeFi platforms that collapse, in their context. I'd like as well to think a little bit about the social and cultural aspect and how the public, let's say, has come to look at banks or the financial system. And again, I'm going to refer to Celsius because the CEO, Mashinsky, who was no spring chicken, was constantly wearing a hoodie. One says, unbank yourself, and the other one says, banks are not your friends. So he was clearly leveraging on this public appreciation or lack of appreciation of the financial system. Or how do you see that playing out in, let's say, the attractiveness of crypto in general, but CeFi in particular?
Yeah, I mean, post 2008, there was a big backlash towards the banking sector as a whole. I mean, we had that historically as well. When you go back to 1928 and the Wall Street crash, and then after that, I did economic history, but after that, you had something called the Glass-Steagall Act in the US, which was effectively the separation of retail banking vis-a-vis the riskier investment banking side as well. And then over time, things almost go back to where they were. And of course, post 2008, some banks were forced to create good bank, bad bank in terms of the way that certain riskier assets were ring-fenced. But that said, some of the backlash that resulted led to some organizations playing on that to say, okay, there's an alternative here, and we are that alternative. I guess the holy grail is banking the unbanked and financial inclusion. And then you hear things like, yes, we want to align with the United Nations Sustainable Development Goals. And certainly that message resonates, whether you look at the poorer in society that have less access to the banking system or have less assets per se, but also certain emerging economies where there's no coincidence that crypto activity has been taken up more so than some Western activities, because the likes of Africa, some countries like Niger are 3% banked. And having been there and some of that region, there is really a lack of banking infrastructure. And so there's the opportunity for citizens who have mobile phones and smartphones to leapfrog that. And it's much easier for them to access services via an app, which the traditional banks have been slow to move into, and register easily and either trade Bitcoin or get into these types of borrowing and lending plays and yield than it is for them to open a traditional bank account. And so the barriers to entry are a lot lower. That said, a lot of these organizations touting themselves as the answer to banking, ironically, were doing things in a way that was much more riskier than the banks that came down in 2008, and some like Bear Stearns and Lehman ceased to exist. Despite the fact that they were propagating that message, some of these neo players had even more risk. And one thing I would say, I'll take a neutral view, because with us, there is no shareholding from the neo side or no shareholding from the traditional banking side with what we do at GMEX Group. But really, when you speak to tier 1, tier 2 asset managers and broader buy-side players as a whole, a lot of them are very reticent to use some of the neo players, rightly or wrongly, and this is their view, not mine, but they're quite open to their banks offering them a service in this space, even though some of the banks have been slower on the uptick, some more than others, because they say, look, trust, we've been working with these guys, if not tens, in some cases, over 100 years. And really, the real money is still the other side of the banks. Whereas on the neo side, pure crypto side, a lot of it is retail into prop. And actually, the real opportunity is how these types of activities then come together and merge together to create a better ecosystem ready as we move forward.
I think that's the real opportunity. And it's important to remember that the real opportunity for real life problems, like you mentioned, unbanked, and how it can affect people's, let's say, ordinary life if suddenly they become not banked, but access to financial services. But that discourse is easily used, I think, in particular in those Mashinsky t-shirts, as a rallying cry for something that might not be so positive. The last aspect back, if we're looking back again, that I want to touch upon is the regulatory aspect. Because with this, as we said, bailouts, there's been a much tighter regulatory control of all the banks, and you mentioned it. And I think that also gave us a sense of security, perhaps in terms of all financial applications, and by extent, some that were not necessarily regulated. Are you able to touch on that?
Yeah, it's interesting because everyone talks about regulation as one big thing, but there's no such thing as global regulation. Even in the TradFi side, or on the TradFi side, there's traditional exchanges and you have to get regulated in different jurisdictions. Or if you're EU-based, you're passported into other EU countries, or banks, whether it's a banking license somewhere or whether it's operating as a branch. A number of years ago, there were high-profile cases with DM and Facebook at the time, it's stablecoin and others, talking about this cross-border stablecoin and the ability to have cross-border activity. But there is no such thing. That you effectively, through partnership or in your own right, got to be regulated. And so exchanges like FTX, amongst others, even Binance more recently, began to realize that. And obviously, when you come from an unregulated background primarily, to adapt to regulation can be quite challenging. That said, also it depends on the asset class, because everyone speaks about spot cryptocurrencies, but in Europe, any kind of derivatives have to be on an exchange or marketplace and are covered in something called the Markets in Financial Instruments Directive too. So it depends on what you're trading. And in any case, the KYC and AML aspects are generally under some form of regulation. Ultimately, what you're beginning to see is regulations emerge, but they're very different country to country. And in some cases, it could just be authorization because of certain types of activity. Like the FCA don't regulate crypto, but they've got something called 5AMLD, which effectively allows them to authorize firms for crypto activity. But that authorization is very different to regulated activity. So what you've seen now is some of these firms like FTX have got licenses in different places, Dubai is emerging, and other jurisdictions through acquisition as well. But there again, the issue arises, there's a lot of activity out there that's still unregulated, and there's also regulatory arbitrage. So for example, if one regulator clamps down, then you had the likes of Deribit moving from the Netherlands and Amsterdam out to Panama, for example. And I'm not saying whether that's good or bad, but you are seeing this regulatory arbitrage. Or recently, the Seychelles has said, okay, we want to introduce virtual asset service provider rules, because there are a lot of exchanges on the crypto side operating there, but they're operating as just company setup as well. So some of these ventures, they might get one small part of regulation somewhere, and then they end up saying, yes, we're regulated. But in reality, when you look at the small print and you go to the bottom of the website and then you really hunt, you actually see that it might not be as good as it seems in many cases.
Yes. Again, I'm looking at Celsius, and they say, why trust Celsius? And there are 3 badges. One is the seal of the state of Delaware, which I guess where it's incorporated. One is ISO 22701, and one is FinCEN, which is, I guess, the AML side of things. So it has a lot of badges, but it doesn't mean that there's any regulation in terms of its activities at all.
Yeah, exactly. So all of those, ISO is quality mark, a type mark, and then accreditation. Delaware, yes, you've incorporated a company in Delaware. Yes, FinCEN, there's some level of KYC and AML activity, but actually it doesn't mean the entity is carrying out regulated activity. And that's exactly my point here. Ultimately, some ventures are getting regulated now, and you are seeing a degree of legitimacy there. And I think regulation, I'm all for it, as long as it doesn't stifle innovation as well. And I think increasingly you're going to see more and more regulation, whether it's in the US, which is a huge market for this type of activity, but also in different global jurisdictions as well. And typically, as has happened historically, as the US regulates, and the US market's a huge market, others will have to conform. And then things like the Financial Action Task Force are doing a lot of work in this area as well, with standards as well.
I think we've painted a good picture of those various strands: technological, cultural, regulatory, and compliance. And one of the things that emerge is that although there's a reality, for example, you said, okay, the crypto opportunity for the unbanked is something significant, the discourse or the message like unbank yourself is used in a different way. And in the same way, when I see, again, on Celsius, but it's not to pick on them, I guess we could do the same with many other of those Cefi, when under compliance, they put those badges, which is they're incorporated in Delaware. Yes, there's FinCEN, and yes, they're ISO 27001, but really none of that means we could trust them. So it's really about the marketing, the messaging, versus the reality. And there's a big gap there, which obviously we realize it now, but for those that had done sufficient research or looked into it into details earlier, they could have figured out that the reality of this thing. And like I mentioned, as a user of some C5 platforms myself, I can tell you my story is that I started by dipping my toes very little and said, I'm not going to read the whole thing anyway. I'm going to put very little money. And yes, it does double-digit figures every month, and it works, right? And I can withdraw, etc. And so it's what is all there is, which is a typical cognitive bias. And then you put more and more, because where else are you going to put your money, especially if you're worried about the equity valuation, as you should be. And that's it. And I guess that's my personal story, and really I'm not proud of it, but I think many people fall in the same trap.
Yeah.
Or perhaps that's my way to say we're not all stupid, but perhaps there's a bit of that as well. Sorry, maybe you want to comment.
Yeah, no, I mean, it's interesting because you're right. I mean, human cognitive behavior, you try something, it's good, and then all of a sudden you put in more and more, and then you tell your friends, and then they follow in. And then it was interesting before this recent crash. One of my friends, he works with IBM on the fintech side. And we were getting a cab home after a night out, and my mum is pushing me to invest into cryptos. And this guy's mother is probably late 70s. And when the mother's, especially the grandmothers are saying that there's a problem and the hype cycle's gone too far. But certainly that message was reaching out to, I mean, not just Generation Z and millennials, but much more widely into the older population as well. And it's unfortunate with these recent events. But that said, you've also seen that in equity markets before, with certain types of activity, and then everyone piles in, and then there's a market crash, and then retail investors suffer. The recent UK SEO crypto sprint a few months back, and I was fortunate to attend. And one of the topics there, I mean, one was DeFi versus Defi and how do you regulate them? And one was around digital custody, but the third one was around investor protection. And how do we ensure that retail investors are genuinely protected? Again, everyone was broadly in favor of opening up the asset class and ensuring access, but wanted those kind of checks and balances at the same time.
Another aspect that I want to talk about is the funding of those platforms. BlockFi, for example, had raised 1.4 billion. That's before the bailout by FTX. Celsius had raised 864 million over 7 rounds. And the latest valuation was around 10 billion. So we're talking about very well funded in, let's say, compared to any other type of startups, because they're fairly new companies. So startups, even if they manage like tens of billions of dollars, do you think we can compare this Cefi with other fast growth, VC backed, consumer facing tech? Is it a similar thing at play?
Yeah, it's a really interesting question because, again, with our own funding round, et cetera, and comparables, we've been looking at market valuations and we've been looking at kind of consumer tech and B2B vis-a-vis then the outlier up until the recent correction being the cryptech sector and some of these initiatives. And we found, looking at certain statistics like GP Bullhound and the like, if you look at various consumer tech businesses or fintech businesses in general, the general multiple on valuation was something like 12 to 15 times earnings as well. And then when you look at kind of profitability and EBITDA, then ended up being 20 to 25 times. Now, if you compare that 12 to 15 times earnings with what was happening in the crypto sector, 50 times wasn't unheard of. And in some cases, it was 100 times earnings. So you would argue that some of these valuations were overinflated because effectively through the hype cycle, there was a level of forward valuation built in to those multiples. And also some of this is due to some of those macroeconomic factors we speak about, because cash was sat there. There was very little yield on cash in bank. The private equity firms effectively got lots of contributions of cash. And once they have it, they have to deploy it. And by deploying it, they generate a return. But that also then creates this whole valuation cycle where, great, all of a sudden you get something away with investment at a certain valuation. Now, these very investors then want to increase the valuation and bring in other players on the next round and the round after that. So you're seeing crazy things where even in 6 months, you were seeing certain valuations quadruple. And then a lot of these organizations were overhiring as well. But with that valuation, there's no such thing as a free lunch, right? With that valuation comes a different kind of pressure because you have to basically keep the growth in terms of client sign up, in terms of revenues coming as well, and that kind of positive news story, because that's ultimately what drives the valuation, even more so than profits in the near term for a lot of these startups. And therein lay the problem, right? Because as that revenue pressure mounted, you have to look for revenue in different places where you wouldn't otherwise look for revenue, because you have to drive that valuation because you've got investor pressure. Therefore, you start taking risks that you wouldn't have taken previously, and therein lies the problem. And then ultimately, it's a domino effect, or where that whole pack of cards comes tumbling down.
Yes, growth is an obligation. My guess is therefore those platforms could never say, oh, actually our yield is no longer, 15% or something like that, because we don't have the same opportunities, or it's much harder to deploy the capital. This was always, the yield never moved, but then they had the problem of deploying the capital. And I guess that's something that's perhaps less consequential when you're talking about other industries where, I don't know, maybe I mentioned earlier, Uber, WeWork, not much happened on the client side, but perhaps there was disturbance to the taxi, perhaps there was issue with the tenancy or whatever, but nobody lost their money. Whereas here, there was a pressure for growth, incapacity of saying, hey, no, we're going to lower, but we're talking about financial service, and we talk about people's savings, which is something really that hasn't happened before.
Yeah, I mean, when your taxi service doesn't turn up, you might be annoyed, but you'll ring up an alternative service or your local provider and then ultimately get from A to B, whether you're late or not. I mean, here, you're right. People have been deploying savings, which under normal circumstances, they wouldn't have been deployed to the extent that they have, just because, like you mentioned, in your personal capacity, you saw those returns, and then that then becomes more and more attractive. But ultimately, this is where now that level of correction, whilst painful, I mean, to some extent, it was needed, because it means some of those risks in grown-up jurisdictions are certainly now being addressed in terms of how these platforms operate, what they offer. Is it security, isn't it? Coinbase had a lending product refused from a regulatory standpoint as well, not so long ago. And again, the regulators, to some extent, have been forced to accelerate how they look at the sector. Again, that's a bad thing if we end up with kind of pragmatic regulation, because this sector is evolving. It's still very nascent. It's still relatively young, and it doesn't need to be stifled. It needs enough oxygen for it to thrive. But at the same time, it does need some checks and balances. And I think we're going to see real opportunity, because whilst there's been some downturn in the market, especially on the retail side, there's been an uptick in institutional activity more generally here, whether it's around structured products and digital assets, because there's been a plethora of announcements on the asset management side, banks getting into custody, asset managers like BlackRock setting up private funds, albeit for professional investors for crypto. That in itself is also going to then lead to better products on the retail side, which will be sold through more traditional channels as well. Because when you speak to asset managers or traditional funds, again, or even financial advisors, their own portfolios are commoditized because they're all offering a similar thing. So they want to get into new types of products. And as they get into those products, and if they touch retailers, there's naturally going to be more regulation. But in many ways, it's also going to encourage much more wider adoption. Because as you rightly said, George, I mean, I always laugh when the word trustless is used, because what does that really mean? Ultimately, whatever technology is used or whatever mechanism, there's got to be a degree of trust behind it. And that's where we're headed towards, really. And I'm positive about it.
But would you say Bitcoin is trustless now? Or is that the only example of trustless? Or is there nothing that qualifies?
Yeah, I mean, it's interesting because even then you could argue with Bitcoin, yeah, there's a consensus mechanism, but some not so long ago touted that there was a concentration of miners in certain jurisdictions like China and elsewhere before, that clamped down. And equally, if you look at bridges between blockchains, there's been a number of high-profile hacks recently, and a lot of people cite that's down to maybe bad code and developers, but actually, in reality, a lot of the inherent issues are around the types of bridges being used and that consensus mechanism, and who actually runs it and who actually controls it as well. I would argue there is no such thing as trustless, that there are some things that can be more trusted than others, right? Whether they're decentralized or centralized.
Sure. And so we're now talking about this future. What could it look like? And you mentioned that institutional and could play a significant role, and their offers could extend to a larger part of the retail public. So what kind of institution are we talking about? Are we talking about the traditional banks and fund managers that we know of? Do you think they could take a greater role in this offering DeFi, for lack of a better word, or crypto opportunity to a larger audience?
Yeah, absolutely. I mean, recently as a firm, we've been speaking to a multitude of these players on the buy side who interact with both professional investors and also retail investors as well through their fund product offerings. And when you say to them, what do you really want? How do you want to get into this space? So some traditionally, and this is all public news, the likes of Invesco have gone out there, lead coin with Zodia, the custodian run by Standard Chartered Bank. And then they put a traditional wrapper around that to create a Bitcoin exchange traded product. And they've listed that on traditional exchanges such as Deutsche Börse in Germany and cross-listed it on SIX in Switzerland. And that when it's on exchange is offered to a range of both retail and institutional investors as a product. But as you move forward and you speak to buy-side players, they say, okay, great, we want to create more products. But for that, we need to access more custodians. We need infrastructure that allows us to do that, because each one of them is running on different technology. But we just don't want to offer this type of product traditionally. We also want to tokenize it, and we want to distribute it through select digital exchanges, because we see the value of integrating with new types of users, millions of new users, with things like wallet integrations. So how do we do that in a way that is compatible with our existing infrastructure? Equally, as some of their businesses have got commoditized, they say, look, we also want to get into yield. And how do we get into yield, and how do we offer these types of fund products to our users so that they can generate returns? But when we do that, we just can't interact with anything non-custodial that we don't know the origins of. We've got a brand and we need proper KYC ML. So you're almost going to see a two-tiered kind of dual system where you've got kind of interaction that's decentralized with where the origin isn't necessarily known or clear cut, but and it's non-custodial, but you're also going to see something that's more custodial in nature, and you are seeing it where the origins of that in terms of know your client or anti-money laundering is more assured and known, and that's what these institutions can then interact with. And really, as we move forward, you could say that I can envisage a scenario where there's two types of Bitcoin prices, right, for the same asset. Those that are within a bona fide system, and those crypto proponents of decentralized are probably going to write in and complain or message and complain on this one. But ultimately, you're going to see those that are within the system and legitimized, and those that are outside the system but maybe used for illicit activity. We've seen some of the authorities to go against some of these crypto mixers, for example, because it's all about controlling anti-terrorist financing and money laundering and things like that. Effectively, it's almost like we've seen the dark web, the legitimate worldwide web that you and I see, but you are going to end up with that kind of dual system in crypto. You could argue that it already exists, but it's going to manifest itself more and more as regulations come into being.
So that there will be a cost to that, but that's a fairly normal evolution, I would say. More regulation means less pure efficiency because regulation is friction, but then less Cefi collapses or less collapses as we've seen in the past.
Yes, and it also raises an interesting question, which again was a hot topic at this recent UK FCA crypto sprint I was at. How do you actually regulate DeFi? Because DeFi, great, you can regulate it. There is a financial services regime today, and it's very easy to adapt that, tweak it, and then regulate these Cefi exchanges or borrowing and lending platforms, because this type of activity in traditional asset classes is already regulated today. So you don't have to reinvent the wheel. But with DeFi, if it's a DAO that's set up, the jurisdictional origins aren't clear cut, or it's smart contracts and there's an opaqueness around who controls what, it's very difficult to regulate it because it's outside jurisdiction ultimately. And if you're trying to regulate it and you're in the US and the UK and it's somewhere else, or it's not clear cut where it is because some things are more decentralized than others, what can you actually do here? And what we concluded, and we had a broad mix of industry experts on our table as well from the banking, buy side, crypto sector. What we concluded was actually blacklists are very negative, right? Actually have a whitelist where there's a certain level of standards that you expect from these types of platforms. And then in country, you have a whitelist, and if they broadly conform to those standards. And there's also a level of self-audit, whatever that might mean, whether that's smart contracts audit or whatever you deem to be, because this debate is also raging around stablecoins with lack of audit and transparency in some cases. Some have it. So we're going to also see some level of self-standards emerge where you end up seeing it as a selling point, because especially in this kind of market with a collapse, consumers now question what's a good platform versus a bad platform. And if you can show that you're doing things and you're following best of breed standards, and you can demonstrate that, even if you're not necessarily regulated, because that regulation doesn't maybe exist in some cases, there's a flight to quality that will generally ensue. And I think that's what's going to happen. And that's how we bring DeFi closer in and create more trust in what should be a trustless system.
That's very interesting, because you could take the reverse point of view of that, and you could say, as an individual investor, I'm willing to take more risk or do more research, go into a more nascent protocol because I want to get more risk, and also because I feel like I have the ability to do that. And one aspect that I think is really interesting about DeFi is that whereas in traditional finance, we don't have access to the same kind of tools. We don't all have access to the same kind of tools. I cannot do non-deliverable forwards, for example. Or whatever. I will never be able to do that. In DeFi, I can, for example, I can replicate all the strategies that I've seen Three Arrows Capital and Celsius doing. And I think there could be an opportunity as well, a trend for individual investors or semi-professional investors to really develop and flourish there.
Yeah, it's an excellent question, because it raises a number of points, right? Because at the moment, really, investors are put into two buckets, typically professional investors, and then all of a sudden you come up with an arbitrary amount where certain jurisdictions say, look, professional investor is someone that has more than $100,000 to invest, and the rest are retail investors. You're absolutely right. Some retail investors are much more savvy than others, but really that's a minority, because broadly a lot of retail investors might follow the crowd and might be less well informed. And actually it's those types of investors that need the most protection. But of course, when there's millions and millions of investors, it's very difficult to tailor a case for near on impossible for every single one. So you've got to come up with these rules and guidelines, professional versus retail, and really therein lies issues. So yes, there's no doubt that the financial system currently has been more restricted, because even these PE funds, if you're a high net worth individual and others, you get to see the best investments and money makes money, but those investment opportunities don't really get to retail investors until they're much higher valuation, and there's much less multiples of return potential as well. One of the fundamental issues is how do we open up access to those opportunities? Now, if used correctly, digital assets offer that opportunity through fractional ownership and being able to manifest itself. And yes, the tokenization of securities and funds and other assets has been slow, but it's actually genuinely picking up now, where a number of players on the institutional side that deal with retail are beginning to make plays in this space. And as that system gets more democratized and is more accessible to you and I, we start to get better returns, different risk appetite, because I may be comfortable getting 6-7%, much like you would with some bonds. I don't want 0.1% in the bank, but equally, I don't necessarily want the risk of a 10 or 20%. But then you could have different risk weightings. So we're seeing offerings out there that have high, medium, and low risk weightings. But actually, that makes it easier to understand, because you and I can then make a call vis-a-vis the return, what risk we're willing to take. And I think we are going to see standards like that beginning to emerge. And there's some real innovation happening there as well, because there's an offering that will launch soon that we're working with behind the scenes. And that's looking at smart contract threat detection. The likes of Binance today published a list saying these 50 initiatives on the coin side might be scams. But how do you I know what is a scam versus what isn't? Because there is good and bad information, accurate and inaccurate, on the internet as well. Some of it propagated by those carrying out those very scams. Threat scores, threat detection, risk weightings all help us make a more informed decision, much like research does today with retail investors if they want to follow it, whether it's technical or whether it's more fundamental.
Yeah, sure. And going back to Cefi, there's an interesting thing, I think, that I'm sure many investors were not conscious of or didn't pay attention to, is the small print. So for example, Celsius said, when you sign up, you give the right to use, sell, pledge, rehypothecate the asset to Celsius. And many people point to that as, okay, it's unlikely that you're going to get back your funds. But I would guess that's, it's something that first, no one read. And secondly, even if you read, what does it mean? It's complicated. So yes, it's more about the signaling of certain aspects that are essential. And if we had that, whether it's whitelist or, I don't know, whatever, highlighting a specific sentence in the contract or things like that, that could go a long way, and perhaps without requiring full-on regulation.
Yeah, I mean, look, ultimately, it's got to be about being clear and transparent. I mean, it's often there's adverts, whether they're online or whether you're traveling on the tube, you see them around crypto, but there's clear print around that's visible that describes some of the risks or the regulatory aspects of that. And misleading adverts are forced by the FCA to be taken down, for example, and just talking about one jurisdiction. So I think naturally, given what's happened, we're going to see more around how things operate, how secure or not secure assets are. Obviously, naturally, as organizations, if you're trying to sell something, you're naturally going to highlight the key selling points. Those things that are more disadvantageous or act as a hindrance to you selling the products are almost hidden away as well. And I think that needs to become more transparent. I think ultimately it's all about investor protection and clearly understanding the risks. In Latin, there's a phrase that often used called caveat emptor, buyer beware. But at the same time, ultimately, the buyer can be aware or beware, depending on understanding those risks better. So I think as an industry, we can do much better there. And that's not waiting for regulation, because sometimes you've got to get ahead of it and drive the regulatory agenda and show best practice before it then gets adopted as standards. And the industry's the best way of driving that, as opposed to waiting for regulators, because the theory can be quite far removed from the practice. And so it's a balancing act in many ways.
Yes, indeed. I mean, again, going back to our starting point with Celsius, I think a lot of it, from what I gather, is really about the messaging, the marketing, which was very convincing, very well done, but also because we were not used to read such things. We're not used to read the contracts. We're not used to having risk on our deposits. We were saved in 2008, 2009. And therefore, this all really, and to millions of investors who poured their money in.
Yeah.
But there has to be a better balance. There's a quote that I like, and it's not in Latin, it's from a crypto guy on Twitter. He was saying that we've been protected from so many opportunities that we forgot what it means to be free. I find it also quite inspiring because it also means that we can be free and take more risk and get wrecked, but that's at least an opportunity we have, or that's a choice we can make consciously. Then it's a real opportunity for investors.
Yeah, I mean, at the end of the day, much like we said, I mean, the financial system needs to be open and more inclusive. I'm a big proponent of teaching people how to fish rather than fish for them. And I think education plays a large part. Even in crypto assets, you've seen kind of consumer and retail courses, whether it's in securities buying or then derivatives in terms of options and the like became prevalent. There needs to be more education on the crypto asset side so that people understand the asset classes, whether it's spot or whether it's derivatives or variant thereof, and they understand some of the risks and some of the broader market issues as well in terms of market structure. So I think education will play a key part. Ultimately, you and I as consumers, I mean, or even if it's institutions, whether they include a part of this in their funds and what percentage is there as an asset class or a corporate with this asset class as a proportion of balance sheet and treasury, I mean, ultimately, it will be different with different individuals and different organizations, and risk appetite will always be different. It's no different in TradFi today. And ultimately, what we've got to ensure is a level playing field. Now, the example that we've drawn on investments being more inclusive and open on the TradFi side, absolutely. In the crypto side, what does a level playing field mean? I think you're going to see more decoupling of activities because at the moment, almost in crypto, the word having come from an exchange background and enabling exchanges now with what we do, the word exchange is very misused because exchange really shouldn't have risk. Because if we look at traditional exchanges, they buy and sell, but whether there's a clearinghouse or whether there's settlement activity, that happens segregated somewhere else as well. And the exchange is always flat in terms of what it's doing. But ultimately, these crypto exchanges have market making within them. They have broking, many of them. They have funds activity, they have borrowing and lending activity, and then they have what's more of a traditional buying and selling exchange function. There's been noise from the CFTC and SEC and then US policymakers that they want to decouple this a lot more so that there's less conflicts of interest as well, because sometimes it's no coincidence in certain cases in periods of large activity. Yes, of course, there are challenges in terms of withdrawals because of block write times, etc. But you've had certain investors, rightly or wrongly, allege that when they've tried to withdraw and they've been up in terms of profit, that those withdrawals have been restricted at such time as their earnings flatten out or they're even in negative as well. And really, you've got to question whether that's fair or unfair rather than a sheer coincidence as well. So we've got to level the playing field here, and then may the best offering and may the best investor win, ultimately.
Yes. And just going back to, and we're going to conclude on this, going back to what you mentioned about education, so I'm going back to my personal anecdotes. I've also launched recently this course about DeFi and about opportunities that are not trading, not non-directional. So lending, staking, potentially hedging your position because you can lend and borrow, or even liquidity providing, things like that. So yield opportunities. And as I was building that, I realized that there was no magic in those Cefi platforms or anything like that, because they were making us, I think, believe to a large extent that we would lend their money to them and they had some special skills, something unique, that the playing field was not level, that they could achieve something that we couldn't. And to some extent, okay, with Ethereum and the gas fees, not everyone can have access to the same thing. But that aside, basically there was some magic, and really there wasn't. And if we knew that, either we would be more suspicious or more aware of what we were doing, or we would basically potentially replicate it ourselves. All that you said resonates, the playing field, the need for education, and the fact that once we go past that, there are many more opportunities for investors and also for, let's say, financial activities. And that's a good thing. Let's not forget it.
Yeah, it's a really interesting point as well. I mean, what I'd like to say there is it was interesting. A few days ago, the Brazilian central bank governor cited that the world we're heading in, credit cards will cease to exist. But why and what does that mean? Now, a lot of the apps that we're accessing, even in the type of Cefi, Defi marketplace, they're siloed apps. There's different offerings. There's multiple apps. But ultimately, whether it's you or I, whether it's an institution, we should seamlessly be able to make a fiat payment and fiat activity or switch from crypto to fiat and invest And we should be able to do that in an aggregated fashion and with all that back-end plumbing taken care of. Now, what does that mean? I think we're heading to a world of genuine hi-fi or hybrid finance. And us as an organization have been a big proponent of this, where we're saying, look, centralized activity, whether it's TradFi or Cefi, isn't going away anytime soon. Decentralized activity is growing, and these contracts will evolve. The data and the AI that drives them will also evolve. The Oracle services that feed them, whether centralized or not, will continue to evolve and enrich. But ultimately, you as George or me as Hirander or asset manager A or B, we want to invest. We want to be able to conduct activity irrespective of our time horizon, whether it's short term or medium term. We should have the ability to seamlessly do that with an entry point. It doesn't matter whether it's this app or that app, with those back-end rails seamlessly coexisting and being more intertwined with interoperability between them. And I think this is where we're genuinely headed, because that's where the maturity comes, because both the fiat currency side and traditional finance is just as important as this kind of growth area in terms of cryptocurrencies. And of course, there is activity that's crypto to fiat as well, not just crypto to crypto. Beyond stable coins, there's going to be central bank digital currencies being introduced, and everything has to coexist and everything will coexist. And I'm very positive that there'll be organizations that solve that, but also more broadly, jurisdictions working together as well that will encourage that type of innovation and activity.
Yes, so it's the collapse and the end of Cefi will hopefully let the proper hi-fi or hybrid finance emerge.